All right. Good morning, or I guess evening, depending on where in the world you are. Today we're going to do an unscheduled, quick live stream about on the topic of GameStop. Only because it's big and in the news. I only have about 15 minutes, but I think it's going to be interesting. I've had a lot of people ask me about it. Part of my professional capacity as an investor, and I actually invested in GameStop about 4 years ago. So I did a lot of fundamental research into the company. So I have some expertise. um, I'm by no means an expert, but some level of knowledge at least around GameStop and the fundamentals of the company. So I'm not 100% sure where to start, but I guess the first place to start is anybody who knows what GameStop is kind of seen this kind of crazy meteoric rise of a stock price over the last. I mean, it's really been going on for a couple of weeks now. The stock was $4 like 4 months ago. Now it's $400. And a lot of people see that as a way to make money, and a lot of people lost a lot of money. And some of those people are hedge fund managers who are supposed to be very smart, and I think they made a big fundamental error, kind of in what they were doing. And I actually was triggered to talk to Matthew about this because I'm going to butcher his name, but I saw an interview with Chamath Palihapitiya on uh, on CNBC yesterday. About a half an hour interview, it was very interesting, and he was making some very interesting points, which I think are some of the undercurrents surrounding GameStop, which is why I wanted to talk to you about it, Matthew. And that is,
Yeah, well,
go-
let me play stupid for a minute and just walk it back for a second. A stock price, you can buy a stock, it goes up, it goes down, and there's this whole game, which it might be helpful for a lot of people, and it'd be helpful for me to understand what is buying a short position or a long position, a put, an option, because it's that sort of game at an unprecedented scale that has created this whole current situation that then we can get into sort of what happens when it gets this big. But what's a put? What's a short? What's an option?
all right, so that
Especially with GameStop.
for sure, and I'm going to do my best to explain that in 60 to 90 seconds, even though that could be. I've taken hours to explain this to other people. I just don't have that time
Well,
now.
I know that I've done before a little bit. You buy the right to you pay a small fee to have the right to buy a stock at a certain price by a certain date, or to sell a stock at a certain price at a certain date. Is my sort of shorthand understanding of it.
Correct, and that's exactly the correct understanding. And the question is, how much do you pay? And the rights are to buy, and the rights are to sell. And so, what I
And,
typically in
and then
invest,
what happens if the price doesn't go the direction you were hoping it was going to? What happens to you? If you how much risk do you take for a long position or a short position? And
right?
that's the thing I think a lot of people don't understand. How is it just by playing around with the stock price, is there suddenly billions of dollars at stake and large hedge funds going under?
Okay, so this is where options get more complicated because each option has two sides of the trade. And so the
Yes.
typical long and short notions kind of get reversed and flipped around in option land, where it gets a little bit crazy. Because if you're buying a call option, which gives you the right to buy a stock at a certain date and time, somebody is selling you that call option,
Mm-hmm.
right? And so the person who's selling the call option, specifically a call option, is taking an asymmetric risk. I mean, they're getting paid, whatever dollars it is, let's say $5 for the right to buy the stock at a certain price at a future date, right? But let's say I'm selling you that option, and that option goes to a million. The stock price goes to $1 million from $5. All of that, I have to pay you out. I mean, I have to buy that stock from you. So actually, I have to sell you that stock at $5 at the expiration date, even though it's worth $1 million today. So my
Yep.
my my downside risk in selling a call option is unlimited, basically.
Mm-hmm.
And the same thing happens in the put option, except that there's a limited downside in that if I sell you a put option, you buy a put option, that gives you a right to sell a stock. It's like you're basically buying insurance, right? You're basically buying insurance on the stock, and I'm selling you the insurance. So let's say GameStop today is $400, right? $450, some crazy number, and it bounces around all the time. Like if you wanted to buy insurance, you own GameStop. Let's say you owned it since it was 4 because you believe in the company, right? You want to buy insurance against the market taking a downturn or even GameStop taking a downturn, but you don't want to sell the stock because you still think it has upside. But you want to buy insurance. So you might come to me and say, hey, I would like to buy a put option, let's say at $300. So you're willing to give up some of that. How much is it going to cost to insure my GameStop stock that it's going to be above $300, right? And today those numbers are crazy, and especially in GameStop because the volatility is massive. But your risk is whatever. Let's say we agree on a $5 price. Your risk is still the $5 that you paid in option premium, and my risk is the maximum risk is if the company goes bankrupt, right? And it goes to zero, right? So then I lost $295, $300, which is the price we agreed on, minus the $5 of the option premium. And so depending on which side of the option trade you're taking a certain amount of risk, if that makes sense. But what I kind of found interesting is this narrative that's going on about and two things, narrative and tech censorship. And those two things are happening very interestingly. One, the narrative is there's this little guy against, the Main Street takes on Wall Street, or retail is beating Wall Street. And that's I understand how that narrative has a lot of attraction to people. And there is some truth to it. But at the end of the day, GameStop is going to fall back to earth because their business is fundamentally broken. And the people that are going to get left holding the bag are going to be retail investors because, I guess there could be some hedge funders that are going to play this for momentum and try to see kind of how it rides and how far it runs. But at the end of the day, look, Tesla is a company I can't really understand its fundamental valuation, but at least there's a fundamental case for it trading at, I don't know, bazillion times earnings or something. But meaning because people think that Tesla as a company is going to change the world, right? Eventually every car may be a Tesla. And that's the bull thesis. I don't really subscribe to that thesis, but I can understand it, if that makes sense.
Well, let's back it up for a second, though, because the fundamental purpose of issuing stock in the first place is to raise capital for a company to invest in growth, invest in technologies, invest in marketing. Isn't it theoretically possible that GameStop itself could have sold or issued some stock in the course of this rise and use that capital to do something that saves their business and makes it worth more than $4?
Yeah, that actually would be nice, except that the SEC doesn't allow for that. And actually, we famously saw that happen in Hertz just 6 months ago, where there was a bit of this kind of retail trade around Hertz stock. And Hertz went from 40 cents to $40 or something like that overnight. And there was another big hedge funder who kind of got screwed in that deal, which was Carl Icahn. And I don't cry for hedge funders losing money. Don't get me wrong. If you play the game, especially if you play the game with billions of dollars and you lose, that's on you. That's the whole point. And where my concern is, and where I and it's not really a concern because I can't protect these people, but I think that people need to realize that when they're playing, if you're a retail investor and you're playing the game and you see, oh, this is the hottest new thing, and I unfortunately have a lot of friends that do that many, many times ends in tears because. Not because there's some kind of rigged game or because somebody has an edge. It's a matter of just experience and understanding all the fundamental principles of how the stock market works and what it is and what you're buying, essentially, if that makes sense. Most of these people that are getting involved in GameStop probably don't even really understand their fundamental business.
Probably not. I do think it's interesting that, it was a Reddit Wall Street focused subreddit or a discussion forum.
Wall Street Bets, which has been shut down, and that's what I found interesting.
Well, that's a whole other level of it. But most people who are in that and follow those discussions have at least some rudimentary knowledge of the markets, and that's why they're in that forum. There are ways that out of necessity, big institutions that can afford to can afford to pay for really quality research and advanced, newsletters and the kind of news that you don't get in publicly available news, but you can pay $20,000 a month subscription to these like very advanced, informational research kind of companies that give companies or give institutional investors access to the kind of information that retail and small investors don't have. But anyone can manipulate the market. That's another level of this. I remember there was like a 13-year-old kid years ago in New Jersey who figured out, using like these little Usenet boards, he could drum up the price of a stock using the same exact techniques that Jim Cramer did, where all these people on all these shows, these huge institutional investors, go on CNBC and talk about a stock or talk about shorting a stock, and then they profit from it. This kid had figured out the same game. So there's no inherent barrier to entry to these retail investors or Redditors playing the same games that these big institutional investors play on each other, trying to drive stock prices up or down and profiting from the difference.
Yeah, and I think that's part of what's interesting here, is because there's this. If you watching, and I do, because it's part of my work. The CNBCs, the business presses, it's the Wall Street Journal. There's going to be a lot of derision towards these retail investors, and the retail investors, like the people in the subreddit Wall Street Bets who drummed this up, were 100% right. GameStop is a stock that was 140% short, which means that there are 50 million shares in the float, and this is why the moves are so astounding. By the way, there are only 50 million shares that can trade hands, but for the last week, 200 million shares have been trading hands every day, which means every share is trading hands 4 times. And more than that, there were 70 million shares sold short. And so if you just a quick understanding, and we are running up against the clock here, because I have an 8 o'clock and I have to catch it. But when you short a stock, what you're doing is you're borrowing a share from somebody who owns it and then selling it in the open market. And when I first heard that GameStop was 140% short, it was only like 3 days ago, because I stopped following the stock years ago, right? When I first saw that it was 140% short, I was like, how is that even possible? And then I sat down and I thought through the mechanics, and I realized that there's nothing, like once I borrowed the share from you and sold it to Joe, I can then go borrow it from Joe and sell it to somebody else. And that's how you end up with 140% short. And it's stupid, because all it takes is a little bump like this, and then all of a sudden everybody who I borrowed stock from is coming back and saying, hey, I want to sell my stocks, so you have to give it back to me, if that makes sense.
Yeah, I mean, people are still having trouble wrapping their heads around it, but basically, once it was that and people realized it in this Reddit and they drove the stock price up, they're sort of holding hostage the people holding those short positions, and unless they can, so to speak, cover it. But I'm not sure I quite understand how that works and why they're so exposed.
So here's the thing, right? Let's say you own 100 shares of GameStop, right? And and the stock was then $10, let's say, and I think that the company is BS, right? And they're going to go out of business. I think ultimately the stock is worth 0. I don't, but let's just say, right? So what I do is I come to you, I say, hey, Matthew, can I borrow your 100 shares of of GameStop, right? So, and I'll pay you for that. And what do I pay you? I pay you a certain interest rate, some small, usually it's pretty nominal, but sometimes it gets pretty huge in some of these big plays. Usually it's 3 to 5% annualized, right? I pay you. Plus I have to pay you any dividends that GameStop pays out. So if GameStop announces a dividend, I have to pay it to you. So that way you as the owner of GameStop shares at $10 say, okay, that's fine. Like I'm happy to make that extra 3 to 5%, right? Plus, I still get the dividends. I get 0 downside. I get only upside, essentially.
Right.
Meaning, because my downside is in the fact that your downside is in the fact that you already own the stock, right? And
Right.
your downside. You've rationalized it, right? I come to you and say, I want to borrow your stock because I want to short it. So you say, fine, no problem. So you lend me the 100 shares, and I go and sell them to the open market at $10, right? The idea is, in my investment thesis in this case, right, is that I wait for the stock to go down to $5 or $4 or whatever my internal price target is that I came up with through a lot of math, basically.
Buy it back and give it back to you.
So I buy it back at $5, give it back to you, the shares that are now worth $5, right? And I made a $5 profit per share minus whatever my costs were of holding, right? It's not a bad return if it works out that way. The problem is when these Redditors realized and understood that the stock was 140% short, they bandied together and they started buying the stock. And there's not that
Right.
many shares. There's not that many
Right.
shares out there. So now you,
Right. The
Matthew,
volume
who owns
available
Reddit,
was small.
right? So you, Matthew, own the 100 shares. You've lent them to me, right? But you have the right to call them back from me at any time, and I don't have a
Yep.
choice. I mean,
Right.
I can offer you more money, right? And sometimes this happens when there's a short squeeze on. Sometimes the interest rate for borrowing shares goes through the roof. Like I once was in a stock. I owned a bunch of shares of a company named Cliff National Resources, and or I think that's what they're a coal mining company basically. And this was
Mhm.
years and years ago, and there was a huge short, and there was a bit of a short squeeze on, and I was able to make like 30% annualized return just lending out my stock
Wow. So
because those people who were short the stock were being forced by the other people they had already borrowed stock from to repay. So what they're doing is they're borrowing stock from somebody else at a higher interest rate to give it back to the person who wants it. Now you own stock at $10, it's now 400. You're like, hey, I didn't think the stock companies were that much money, right? So
right.
you call back the short. You go, hey, Shimon, you took the short, right? You owe me 100 shares of GameStop. I want to sell them. Give them back to me. So now I have to go buy them in the open market at whatever price it is. It doesn't matter because I have an obligation to you to give you back your shares.
Uh, so it's
So
a
it doesn't.
contract.
It's a
Yeah.
contract. I have no choice but to go to the open market and pay the price. And that's the mechanic. The fundamental mechanics of a short squeeze is exactly that. Is that the owners of the stock are calling it back because they want to sell it because the price is appreciated rapidly. And then the short sellers have to buy the stock at whatever price the market is dictating.
And what if the short seller like literally doesn't have enough money to do that? Doesn't have enough liquidity to do that?
Then I believe, and I'm not an expert on this, I believe the financial institution that arranged it is on the hook.
Awesome. Okay. So what's interesting about it, these games happen every day, but this reached a scale that it's spilled over into politics in the real world, that there's people shutting down the Reddit forum and shutting down like Newsnet or even pages in other social media about it. And there's a sort of pressure from these big institutional investors for the government to step in and, so to speak, protect them. So those are the two things that a lot of people are taking notice of that are sort of outside of your everyday Wall Street greed.
Right. And so, I mean, there's a lot more to say on this, and I unfortunately have to leave. And this is kind of the stuff I actually really wanted to talk to you about because I think that's the stuff that to me is interesting. I
That's
mean, what
the
happens that's the interesting crux and the interesting kind of bit of this whole thing. And I just and very quickly because I have to go, and maybe we can pick this up a little later, maybe today, maybe tomorrow. But at the end of the day, that I think that activity is 100% abhorrent. I think that censoring these groups and shutting them down is wrong. I think if they can prove that there was some kind of market manipulation where you're not allowed, like if you see, and this is true of hedge funds also, if you see, you're not allowed to make trades specifically to manipulate a market. And so, and the problem is that hedge fund managers actually flaunt that rule every day, or they play very close to it, and it's not well defined. As insider trading is poorly defined, market manipulation is poorly defined. There's not real kind of safeguards, safe harbor, bright lines involved in this, and so it's kind of in the eyes of the beholder, and that's a problem, and that needs to be solved because now they're going to go after these Redditors and say, "Oh, you guys manipulated a market," when it's completely unfair because, like you said before, Jim Cramer or any hedge fund manager who takes an interview on Bloomberg or CNBC on any day of the or Fox Business any day of the week and is talking their book, and because that's what these guys do, and so there's an asymmetry here in how the treatment is being handled, and I think that's a problem. I think that needs to be resolved, and that's what actually Chamath was going on about in his 30-minute interview with CNBC yesterday, which I thought was fascinating. I mean, and then the other piece, which is kind of sad, is that at the end of the day, like I said, the ones who are going to end up holding the bag on this, the ones who are going to end up holding the bag on this are little guys who don't really understand how the market works, right? They're in it for, the market is part investment and part casino. Um,
Yeah. Yeah.
and that's dangerous, right? And the problem is that a lot of people who don't understand how the market works and all the fundamentals and the purpose it serves in society take events like this and they come to the conclusion the market is all casino, and it's not. It's part casino because anybody has a right as an American to do whatever they want with their funds, and if you're going to gamble them on Wall Street, then that's kind of on you, versus invest them. And I mean, that's where things kind of get interesting to me anyway. And I think we should do another live stream when time permits for both of us to kind of go into the issues of short selling, regulation, SEC kind of market manipulation, and specifically, there's a very interesting case of where the SEC brought an insider trading lawsuit against Mark Cuban, and he put on a fabulous YouTube video where he called the SEC and tried to get them to explain to him. He's like, I have this information. Is it insider trading? And basically the end answer was, you have to go to our website and fill out this form, and we'll get back to you in 4 to 6 weeks. And he's like, by 4 to 6 weeks, information will be irrelevant, right?
Yeah. Yeah.
And he did this because he got prosecuted for insider trading. And he was like, insider trading, the problem with insider trading is if you look at the law, there's no bright line safe harbor. And bright line safe harbor is a term that you and I probably should discuss a lot more because it's not very well understood. And it's something that's sorely lacking in our society. And that's because laws are black and white, but the real world is gray. And so it's hard to kind of get there. And with that, I'm getting calls that I'm late for my call. So I apologize, but have a great day. Have a great day. To be continued.
Don't buy GameStop. Not now.
I cannot recommend to anybody to buy GameStop. At $4, it's a maybe. All right.
Okay. Thanks, Jimon.
Bye.